Good afternoon, everyone. Firstly, I would like to thank the CFA Society for giving me an opportunity to be with you today and discussing this important topic. I want to thank all of you for sticking with us until the end of the day and wanting to be part of the solution. And I applaud the CFA Society for bringing this topic at the forefront and organizing a whole event on it, because as presented in the morning, sustainability is existential topic, not only for us in the financial industry, but actually for us as human beings. I'm honored today to be sharing the stage with two very experienced professionals, and we have very limited time. So I'm gonna ask you to please put your mobile phones down and pay close attention, because what we're gonna try to do at the last panel for the day is close the loop and give you as many practical examples and advices as possible to actually ground the discussion and illustrate how you can leave the room today with the right sense of urgency and confidence that you have the tools and the knowledge to act. The topic of our panel is investing in the Sustainable Development Goals. There were a couple of references to the SDGs already, but I think it's very important to make sure we understand what it is. And year 2015 was a landmark year for multilateral agreements. That's the year when the 2030 agenda with the 17 Sustainable Development Goals was agreed, as well as the Paris Agreement on Climate Change. And this paved the pathway towards prosperous and sustainable future. This is what has been the driving force behind the momentum we see picking up in the financial industry globally, the changes in regulation also happening extremely rapidly, and thus all of us sitting here today and figuring out what role shall we play, how can we be part of the solution and not finance the problems. Financing the Sustainable Development Goals is not the problem. Capital exists in the market, but it is not being channeled at the scale and speed that's needed. It is estimated that the financing gap in developing countries for the SDGs is around $3 trillion per year. Now, let's ask a very basic question, and that's where I would like to turn to the panelists today. Are the SDGs truly investable? What are some of the challenges that we as investors face today?
Yeah, so I think they are investable, but they are not all investable. I think as a starting point, the SDGs are a great communication tool to, in simple terms, describe the goals that can create attractive financial returns and have a positive impact on the environment and on society. But clearly, some are much easier to invest in. Like, for example, the energy transition. But there are also a couple that are quite difficult to invest in, like, for example, partnerships. I see partnerships more as a way of accomplishing maybe the other sustainable development goals, but to directly invest in that is maybe a bit more difficult. But yeah, clearly you have quite a couple that are very investable.
Yeah, but Jeroen, I mean, the issue is, isn't it, that a goal is actually not per se investable. What you can say is that you can actually support some activities in the primary markets, for instance, which are pursuing some goals. But as an investor, it's not like we can invest in the S&P or the Turkish market or something like that, but not in clean energy or something or a goal like that. So how do you actually go about this? And I think that is one of the major challenges, from my perspective, in ESG investing, because the goal per se is a very real-world goal, or these 17 SDGs are very real-world goals, but how the finance function actually goes about supporting them is not so trivial. It's not so immediately understandable like it would be with if you're investing in a specific segment or in a specific market or something like that. So we still have a big domain of uncertainty, shall we say, methodological uncertainty, etc., and terminological uncertainty, which we're working to figure out and to work out in terms of practice development. There is a very strongly developing practice, but it's still not set in stone as yet. And by the way, you were actually asking what everybody should take away with them when they leave the room. And let me just very shamelessly plug the publication that actually has been the reason why I'm sitting on this panel. This is the Handbook of Sustainable Investments. If you look on your table, you've got this card, and on the back of the card is the link with which you can download this publication. It really gives you an oversight of the most prevalent methodologies and ways in which you can actually invest sustainably, at least in liquid markets at this point, and all the other practices as well. So it's, I think it's a pretty challenging topic for us as investors in liquid markets. Maybe not so much in the primary markets, in direct markets, when you can actually support projects. But I was actually quite shocked to hear our predecessor panel when they said that they are struggling to find suitable projects to support with their direct investments. So that's actually quite interesting. Maybe also from a Turkish perspective, because Turkey, in my mind, has a great opportunity right now to basically leapfrog many developments that are taking place when you just look at the classical extractive industry business models and go towards an economy that is really circular in nature, or really has renewable energy sources at in its focus. That sort of thing, I think, is a great opportunity, and obviously there would be a lot of funding available for such projects. But again, that's primary market, not the, I guess at this point, not the liquid markets as well.
Yeah. Absolutely. A key takeaway as well is to understand that this space is very fastly moving and evolving. It stimulates a lot of innovation, and there is a lot of development happening in the industry, so it is not a static space. It is not something that bounds everyone to operate within one-size-fits-all model. So there is a lot of flexibility in it, and a room for very, very powerful innovation that unfolds opportunities for financial market participants. One of the myths we hear about often, especially in some parts of the world more than others, is that to do good, you gotta pay for it. It's gonna cost you to be an ESG-focused investor or sustainable investor. Can you help us bust that myth?
Yeah, so I think that's often the pink elephant in the room, that people think, okay, if you want to integrate ESG or do impact investing, it has to cost you performance. It will be at the expense of performance. I think Jamie in a previous presentation already showed a nice overview that yes, in some areas you can choose to sacrifice some returns, but it is not a necessity. We actually have done some academic research as well, which clearly showed that if you look at ESG factors in your investment process, it can actually help improve risk return of investment portfolios, especially if you zoom in on material aspects, material, environmental, social, or governance aspects. And with material, we basically mean aspects that will have an impact on the longer-term profitability of a firm, because that will have an impact on the valuation of a firm and will have an impact on the share price development of a firm. So it makes a lot of sense to include ESG aspects in your overall investment analysis. And I always feel that if you haven't done so yet, you haven't completed your assessment yet of the opportunity you might want to invest in. So I think that's very important. I think Jamie also touched upon the question around, or the discussion around fiduciary duty, which is closely tied to to the discussion around performance. In the past, it was often felt that if you integrate ESG, that's in violation with your fiduciary duty, so you're actually not allowed to do that because it could cost you performance. I think these days there's more and more proof that it can actually help performance, so it's not in violation of your fiduciary duty. And I would personally even turn it around and say, if you do not integrate ESG, if the material ESG aspects, you're actually not fulfilling your fiduciary duty because you're not doing the best you can for your clients. So if you don't look at sustainability in ESG, it basically is in conflict with fiduciary duty. And maybe very practical, if you look at ESG aspects, the academic research we looked at showed that if you focus on companies that are actually improving when it comes to ESG, that those tend to outperform. And if you exclude companies from your portfolio that actually have very poor behavior when it comes to ESG, on how they treat their employees, the environment, or if they have poor governance, that actually also improves your risk reward. So that gives you some tools on how you can use ESG to actually help improve financial performance as well.
Great. I'll sneak in a question that's coming from the audience. Can you maybe talk about the differences in sustainable investing and finance between emerging markets and developed markets?
That's a good question.
I'll
try to give it a shot. I think there shouldn't be one, actually.
There is.
Because I understand that there might be one in the sense of that people set their priorities more on growth, really, and furthering the GDP, which obviously on a level basis is probably elsewhere than in more developed markets. But I think really at the point of time where we are at right now, I think it would probably be not in the fiduciary duty of the investor, or basically in the economic sense for the investor to not take that into consideration. Because my very personal opinion, and I flag this as my personal opinion, I come from a very Friedmanite, the business of business is business, basically point of view, which means that actually you probably should not take into consideration any extra financial goals when you do your investing. However, if you see, or if it is becoming evident that the global economy actually needs to decarbonize because climate change otherwise will wreak havoc on the economy on the longer term, and if the IPR has recently published its the PRI has recently published its IPR, the inevitable policy response portfolio. That means that a set of policies that will be coming forward in the next 5 years, which include, for instance, the prohibition of new sales of internal combustion engines, also known as ice age cars, etc. So if these kinds of policies are really coming down the line, and relatively soon so, then every investor who does not take into consideration these kinds of developments is really not investing in their own best interest. So from that point of view, I think it would be a mistake to make a difference between investing in developed and developing markets. It might be a matter of basically balancing and tuning, like I said, the leapfrogging element. So you probably want to invest more on renewable energy infrastructure and that kind of thing, because there's more opportunities for that. But yeah.
Maybe to add to that, so I think from an investment process perspective, there should not be any difference. I think in practice, on the emerging market side, it is a little bit more challenging given the data availability, the insights you have when it comes to ESG scores, data points, be it maybe on carbon emissions reporting. So there, I think emerging markets have a bit more challenge. It is no excuse to then not do it, It's more, okay, we have to then work a little bit harder to get those details on the table and make a good assessment. If you look at our investments, then we in practice see actually a bit more opportunity on the emerging market side, because often there you have more pure plays when it comes to some of these sustainability trends, like pure play, solar plays or wind plays, or other examples there. So that aspect might even be a little bit easier, while in Europe, yeah, often these activities are part of bigger conglomerates, which also do stuff that is maybe less sustainable, and then that's more of a balancing act.
I think that's a good transition to the next topic of discussion around data. At Refinitive, we've been collecting and providing ESG data to the financial industry for more than a decade, with the aim to help investors make more informed investment decisions. Now, the data has evolved tremendously over that period of time, and the available data we have today is a lot more than what used to be a couple of years ago. However, it is far from perfect. As many of you in the room may be moving in that direction of ESG integration, and looking at some information to help you make more informed investment decisions, what are some of the challenges and pitfalls that practitioners that's been using ESG data for a very long time would have to share?
Yeah, so in practice we do see a couple of pitfalls or things we really need to pay attention to. There's a huge wave now of ESG data coming online, so great work being done there. What you do see is that if you look at ESG scores of securities, that the correlation between the different rating agencies is 0.3, which basically means that they often do not agree, which to me basically says that these are opinions. So these are not facts, these are opinions. You see that methodology differs between MSCI or Sustainalytics or Refinitive or others. What you also see if you look at ESG data is that there are biases in there, like a market cap bias. So on average, large companies have higher scores than smaller companies. And that's usually because they have a large team that writes nice brochures and have some great policies. It doesn't mean they are more sustainable from what they produce, or that they have a more sustainable business model. So I would caution at least to use the high-level ESG scores in an automated way in your investment process. I would use it as an alert function to really see what the underlying arguments are that make a score high or low. Because in the end, like with sell-side research, where Goldman can have a buy and Morgan Stanley can have a sell, you basically want to know the arguments, and then as an investor decide for yourself what you feel is relevant and important.
Mm-hmm. Another question that's come in, and I think it's important to talk about one of the key drivers of the changes that we see in capital markets. And it's undeniable that they are transforming. And one of the key drivers is regulation. And I guess I would urge us not to be afraid of regulation. It is here to help us be better at our job, and also gives us the tools, equips us to be able to perform our duties and obligations more effectively, as individuals as well as professionals. At the European Union and in Brussels, there has been very ambitious work streams and agenda. I would say probably one of the most comprehensive action plan on sustainable finance developed by a regulatory body to shift capital markets towards being sustainable as a prerequisite to sustain both economic and societal growth in the future. I mean, how is that impacting market participants in Europe? What should we be cautious of, as well as, it's important to highlight, although this is European regulation, it is by no means bound within the EU boundaries. It is meant to be a global framework to shift capital markets towards the 2030 agenda. So it is applicable to all market participants, and we in the financial industry don't operate within boundaries as well.
We're definitely
So
not in a vacuum
yes.
as an industry, and you would be very well placed to understand all that in much detail as the chairwoman of the TG Technical Expert Group for benchmarking, right?
Yes, absolutely. So the question coming in is, how are governments supporting that agenda, the sustainable financing agenda?
Well, there's a large number of activities that are taking place at the EU level specifically, and they're far too numerous actually to go into a lot of detail. One aspect that is certainly going to be very important for the implementation basically of our industry is certainly the benchmarking element, the benchmarking proposal, which is going to go into law very soon, but also obviously the taxonomy project that the EU is working on, which is basically classifying the different economic activities in the economy out there into sustainable or not so sustainable types of activities with the associated consequences. So that's from a very real economy point of view, and which will have consequences further down the line. But one aspect that I believe is hugely underappreciated, which I would like to bring to your attention as well, is the fact that even financial market regulators and the financial market authorities around the world are beginning to pay a lot of attention to this topic, and that is mostly through the vehicle of the Network for the Greening of Financial Services, which is an association of the most important financial supervisory authorities and central banks who are looking at mostly the transition risks that are inherent from climate change and the transition to a decarbonized economy, the transition risk for the financial system. And they're really looking at this under their mandate of financial stability. So this is basically their remit. The most important remit of central banks is obviously the financial stability goal that they're trying to keep the system running. And they see that transition risks can actually pose a threat to that financial stability. And I think it would be really, we would be remiss as financial professionals if we did not take that into consideration. And just as a side note, I checked the other day, Turkey is not yet a member of that network for the greening of financial services. So if anyone here in the community has some influence with the Turkish central bank, then make them aware of that. Thank you.
Maybe to add to that, from a practitioner's perspective, I'm excited and I'm fearful. I think I'm excited that, let's say, more regulation will hopefully help with creating much more transparency, because there's, especially when it comes to ESG, sustainability, I think transparency is very welcome. Firstly, from companies reporting data like carbon emissions and other useful insights. Secondly, from the fund management industry, to really be transparent on what you actually do in practice. To counter the bit of greenwashing that's going on in the sector as well, because of course sustainability is a hot topic also commercially. So I'm very excited that we are going to get much more transparency. I'm a little bit fearful that it might become too prescriptive in how people should invest. And that I always find a little bit dangerous, and you could get negative externalities from that perspective.
And that, Jeroen, is actually where we are challenged, because I believe that this is a space for us, for the industry to develop our own standards and methodologies, get that right and get that in order.
Yeah, we shouldn't let the regulators do that in detail for the practitioners.
And it's important to highlight that regulators rely all of the work on existing standards. So this collaboration is felt across the board very strongly, and it's very important for the private sector to work together in partnership with the public sector to come up with the right tools in the toolkit to help transform capital markets.
And to really coordinate. So what we see now in Europe is that some countries are now coming out with their own standards, like for example in Belgium, the Fabelfin. which is very prescriptive on when you can call something sustainable or not. I do see some risks that France or Germany or the Netherlands might come out with something comparable but slightly conflicting. And that for practitioners that are not bound by all these boundaries, but work on a global basis or a pan-European basis, yeah, that could prevent or provide some challenges.
A quick final question, just to make sure I cover the ones coming through from the audience. We've witnessed the shift towards passive investments. What would that mean in terms of ESG integration? Where are we going to see that being adopted quicker, passive or active?
So my view is actually that we've seen a huge wave going from active to passive in the last 10, 15 years. And that now all of a sudden people on the passive side realize, hey, I'm still in tobacco now automatically. I'm still in traditional coal. I actually do not want to invest in those activities. So what we're seeing now is actually that a large or some parts of passive are now moving a little bit back towards semi-passive, semi-active. So what you see now, including at our firm as well, is that we have ranges where you make active sustainability decisions at the start, both from an exclusionary perspective and a positive selection perspective. So positively select on carbon ambitions, for example, where you reduce basically the universe of an MSCI world from 1,800 stocks to maybe 1,000 stocks, but then passively implement those stocks again with a low enough tracking error that you get roughly the same risk return as the original benchmark. So still from that perspective passive, but with a strong sustainable profile. Mm-hmm. So personally, I expect the big wave towards passive, that we see some coming back towards active decisions on sustainability and passively implementing that, again, with low cost, roughly same risk return. Mm-hmm.
Great. I know we're over time. So to wrap up our panel, I think first point, it doesn't cost to be sustainable investor. It actually costs to be ignorant. Flexibility and a lot of innovation opportunities existing in the market. And there are no excuses. There is enough data, there are enough strategies proven successful, there are enough guides and handbooks to help you make better informed investment decisions. So act and be part of this transformation, be at the forefront of the transformation. Thank you for your time.